Okay, let's start.
So good evening all. Yes. Okay. Good evening all. So today we are going to discuss on the topics forwards and futures. So on the screen you can see the title of it, financial derivatives, and you can see the right side. You can see a famous quote given by Mr. Warren Buffett. He is one of the greatest investors that human mankind has ever seen. He termed derivatives are financial weapons of mass destruction, carrying dangers that, while now are latent, are potentially lethal. So his words clearly says that the potential of derivatives as well as the risk involved in derivatives. And here we have another quote. Actually, it is given by a famous investor. So it says that before commitment commits you, commit to the commitment. It is a very, I think it is very apt. We can say it's a definition of derivatives as well. Before the risk captures you, you should be in a position to capture the risk. So that is how derivatives helps us in hedging and speculations and all. So coming to the slides,
Yeah, Snehith, I have a
here
doubt.
you
Can you clarify
yeah.
why did this Warren Buffett uh, tells this way derivatives are financial weapons of mass destruction carrying dangers that while now latent are potentially lethal. Why this statement put forth? The reasons. What is
So I think that
justification?
the reason, yeah. So I think the reason why he gave such a definition is that derivatives can actually fill us with a lot of money, as well as it can maybe it can also put it as bank make in a bankrupt position, because that is how the derivative system actually works. So I think I mean others also will get an idea on that
Yeah, it
after
is
I
like trading,
on the way of
rather than investment derivatives.
yeah, yeah, it is a speculative tool. So
Yeah, it is a
you don't get
speculative.
any stock or anything from out of it.
It is a
It is
hedging
just that
tool.
you
It is a
get a
hedging
profit out
tool,
of it.
and it is the derivatives are not acted as an investment tool. It is a hedging tool.
Yes, sir.
So that his words are like this. I think Warren Buffett is not interested in derivatives. He's interested in the cash market only. I think so, right?
Yes, sir. He's actually
He's
he's a
an
long-term
investor
investor. He
rather than a
gives
trader.
yeah he gives the importance to the worth of the stock rather than he's not much interested in speculations.
Yes. Okay.
So that's
Carry on.
it about that. Coming to the derivatives regarding I'll give you just a basic definition about everyone. If someone asks you what is derivatives, you can just say is that it derives its the value from an underlying asset. That is, derivatives alone it doesn't have a value. It derives its value from another financial instrument, like that. It can be stocks. Stocks are the most common one which we do actually, and we have bonds, we have commodities like Brent crude or something, we have currency derivatives based on uh, currencies, we have indices derivatives, that is that it derives its value from market indices. So these are all underlying assets: stocks, bonds, commodities, currencies, market indices. These are all types of underlying assets, and derivatives derive its value from them. So this is the basic the definition or meaning of derivatives, I would say. So it is mainly classified into four. That is, we have futures, we have options, we have forwards, and we have swaps. Now you will be having a question why I have given it in a gray red border. That is because futures and options it comes under same bundle, because both futures and options are exchange traded, ETC, exchange traded derivatives, whereas forwards and swaps, these are over the counter contracts. So that I'll explain it. So, but at this point, just understand that these are the types of derivatives that are happen that take place in the market. So first, in today's session, we will be looking into forwards and contracts. So the first one we will be seeing what is forwards. Forwards is nothing but a forward contract is a contract made today for delivery of an asset at a pre-specified time in the future at a price agreed upon today. So the thing is that the terminologies, derivatives, forwards, these things may have come recently, but the thing is that the concept of derivatives has come up long back. I mean, it was when I checked the history, it was like it was evident from the 18th century itself. The concept of derivatives was there, but it might be known as in different terminologies. The terminology of forwards or derivatives came at the later part. So a forward contract, in simply we can say that is nothing but we make a condition that we will buy a particular asset at a pre-specified time at a agreed price. So the buyer of the forwards contract agrees to take delivery of an underlying asset at a future time at a price agreed upon today. So no money transaction change happens until the time of expiry. And on the expiry, the seller agrees to deliver the underlying asset at a future time, and the price agreed upon today is paid, and that is how it is settled on the. So the meaning of forwards contracts. A forward contract is a contract between two parties who agree to buy, sell a specified quantity of financial instruments or commodities at a certain price. Same thing. It is just a contract. A party agrees to buy it and another party agrees to sell it at a specified predetermined quantity at a predetermined date. This is basically what forward contract is. But forward contracts, as I said, is a OTC traded, and it is not a standardized contract. That is, we do not have an intermediary while coming in forward contracts. That is why we say that it is not standardized, and we two persons sitting over the chair, over the table, just they have their own conditions, they discuss it upon, they make the necessary changes in the agreement, and they sign the contracts. This is how forward contracts are. They are tailor made. That is that you can customize it as you want. You can put on your own conditions to them. So the underlying assets, as I said, the concept of forwards has come long back. In the 18th century itself, it was evident. So the classic example of, if you ask any person, he will be telling about the forwards contract is the example of a farmer of a wheat. The same way, the underlying assets, since the ancient times, we had underlying assets as agricultural or physical commodities, even like wheat and all. And later on, it has evolved to currencies. As I said, there are currency derivatives and interest rate derivatives. These are some of the forward contracts, but there are other. Because forward contracts, as I said, it is tailor made. We can make our own contracts. So there are contracts for other items like real estate and all. Real estate is very common form of forward contract. So why do we go for forward contracts? It's a very interesting question, because why we go to choose forward contracts above other types of contracts? So the primary reason is that they are customized contracts, unlike futures. Futures are, they have a they have an intermediary. We have to follow their guidelines and all. But as far as forwards are concerned, we do not have. We can make our own conditions. That is why many people choose forwards. That we make our own customized contract. It is tailor made, and there is no specific guideline which is to be followed while making a forward contract. The buyer and the seller, they make their own rules. That is about forward contracts. And it is useful when for stocks. Yeah, we in India, we have a exchange where we can do futures, but for some other commodities it might be not be available. So in those conditions also, we can go for forward contracts where futures do not exist for certain types of commodities. And it is useful in cases future standard may be different from the actual standards. So these are the reasons why we choose forward contracts. So let's see some of the features. Is already discussed some of the features of forward contracts. These are bilateral negotiated contracts between two parties, and hence they are counterparty risk. That is that there is no proper settlement or something, or an intermediary who helps in settlement of forwards. That's the main risk which involved, is the counterparty risk. There are a risk of default happening in between on parties of buyer or the seller. There are chances of default. So each contract is a custom designed, and hence is unique in terms of contract size, expiration, and asset type. Each contract, as I said, it is tailor-made, it is customized. So the terms and conditions differ from contract to contract. Its contract size will be different, expiration date will be different, everything will be different. A contract has an expiry date. A contract has to be settled or in delivery or cash on an expiry date. The contract price is generally not available to the public domain. That is an important thing. When it comes to futures, everything is available on the public domain. We can review everything. Public can review everything. But forward contracts, I said, it happens between two parties. Everyone may not be, the public will not be aware of the transaction that's happening. if a party wishes to reverse the contract, it has to compulsory go to counterparty, which often results in high prices being charged. Another problem of forward contract is that if a party makes a counterparty default, then the thing is that he has to bear a huge loss in that, because it is again they have made their own condition. So the party making the default, they has to bear all the loss which has incurred due to signing of a contract. And coming to a very the most important one, that is a futures contract. So futures contract in layman's language, I would say that forwards, there still now we have seen what is forwards, and there are many problems which are associated with forwards, and all these problems were actually removed when it comes to futures, like counterparty risk, like there is no proper settlement, like there is no a guideline set by an intermediary. So these kind of flows which was there in forwards, it was removed while it came to futures. So unlike forward contracts, futures are standardized contracts traded on exchange through a clearing house and avoids counterparty risk, through a margin money and much more. There, it is standardized. It is done. We have intermediaries like exchanges and clearing house who settles the contract, and we pay the margin money. In that case, we can also avoid the counterparty risk. So futures contract is a standardized agreement between the seller, that is seller in case of short position of the contract, and a buyer in long position, traded on a futures exchange to buy or sell a certain underlying instruments at a certain date at a pre-specified price. So the difference between the definition here in futures and the definition of forwards, there is only a couple of differences. That is, in here it is a standardized agreement, and here it is traded on a futures exchange. So that is the only difference. In forwards, we do not have such a system, and the futures date is called the delivery date or the final settlement date. It is common in forwards also. We had expiry date. Here also we'll be having a delivery date or final settlement date. And the preset price is called the price of the futures. We call this the preset price is called the futures price. The price of the underlying
Snehith,
asset.
here, can you show some hands-on means future prices, margin?
Yes, sure, sir. Sure,
Okay.
I will show that. So, for example, here in this slide, you can. Is it visible, sir?
Yeah, yeah, it is visible.
Okay. Here, the how futures are being given in the trading terminal is that you need to type, for example, Manappuram Finance. You will be all will be familiar with Manappuram. It is I think it's a company based in Kerala itself. It's a NBFC. So you can just type Manappuram. Manappuram, yeah. Just type Manappuram, and you get what all the things you have regarded Manappuram listed in this. Say here you can see three things: the Manappuram book, that is August FUT, and Manappuram September FUT, Manappuram October FUT. So in India, the futures for 3 months will be listed. That is why we have futures. So July, it is already expired. The last Thursday of every month is the expiry date of stock futures in India. So in the July month, it is already expired. Yesterday, it got expired. So in the next futures we can buy is for August, then September and October. So this is how the things you see in the trading terminal. And similar to stock equity, we can also get into a chart of futures. So this is it is like it also has variations, minute to minute variations, similar to a equity. And I would also like to show you how this thing usually the price of equity of that particular company, that is the price of the underlying asset, and the price of the futures go on a proportionate way, so that I can prove it to you by comparing the equity prices of Manappuram and the futures price. So let's say compare
Snehith,
August
I
futures.
can ask a question here. The future price is more than the spot price, or spot price is more than the future price of Manappuram
Yes, sir.
stock.
Yes, sir. Here, when it comes to the thing is that regarding the futures pricing, that I will, since you have asked, I will explain it. The difference in some points, you can see that the blue line here is the Manappuram August futures, and the white line is for equity. In some points, yes, futures shares come above the equity, and in these points we can say it is down. but it is proportionate. But when it comes to a pricing, there's the difference we say between the equity price and the futures price. It is known as spot future parity. So that the spot future parity is the difference between the spot and futures price that arises due to variables such as, and this the question which you have asked, I think it will answer the variations why equity price and futures price varies is that because of the term things like interest rates, dividends, and time to expiry. And we have a formula for calculating the futures price. That is, futures price is equal to spot price into 1 plus risk-free rate minus dividend. So this is the formula for calculating the futures price. This is a calculator formula used by the brokers as well. So here the components which affect the futures price, I would say the dividend is a very important factor which affects the futures price. Then the time to expiry, and finally the interest rates. So have I answered your questions?
And here we need to explain the buy future and the sell future because it is not clear to them. But it's a difference between the buy future and a long or short future.
Yes, sir. That is a very interesting part of futures. That is that in while coming to
What time we
equity,
can buy
we
a
can
long
only
future
there
and
are
what time we can buy a short future? What time we can?
yes, sir. In we can buy a short future when you think that the market is bearish, and you can go for a long position if you think that the market is bullish. So I hope that you all have the idea about what is short selling. Short selling is that you initially sell at the price and then you buy the shares. So the peculiarity of coming to futures about this short and short position is that in equity you can only do short positions in intraday trading, but while coming to futures it is not the case. You can do it in swing as well. You can do uh, short position tradings. So this is about those things. And coming to slides, um, yeah, the price of the underlying asset on the delivery date is called a settlement price. That is the price of the underlying asset. In this case, it will be the stock on the settlement day. That will be known as the settlement price. The futures is a standard contract in which the seller is obligated to deliver a specified asset. This is an important line here, is that at the expiry date. So in stocks case, it will be the end of the last Thursday of every month. In that case, we are obligated, that we do not have an option to buy or sell. The seller is obligated to sell it and the buyer is obligated. They should do it. There is no other way they can escape from it. So on that day, either the seller is obligated to deliver and the buyer is obligated to buy it to the buyer on a specified date in future, and the buyer is obligated to pay, and the seller, and then the prevailing futures prices upon delivery. So there are various ways in the pricing can be based on, that is there is open outcry system, or bids and offers can be matched electronically. So here actually we have an electronic settlement matching system. That is what that if I can show you, just I will show you how it is. See, yeah, in this Manapuram's case, actually there is important thing is that derivatives we can only trade in lots. So in that lots actually differ from each company to company. In Manapuram, they have a lot of 6,000. So you can choose if it is an intraday MIS or overnight. If you would like to carry forward the positions overnight, that is like CNC, common to cash and carry in equity. So you can, if you want, you can put stop loss, and you just put, and here you need to, if you want to find the margin and how much you have to pay, then you can just you get the margin required here, and you can put the buy order. Similarly, another person will be putting a sell order, and this, if in conditions gets matched, this is they will have a electronic contract ready. Means they will put out the digital signature and the electronic contract will be ready. So about the few features of futures, I would say that futures, we already see it. Futures are highly standardized contracts that provide for performance of contracts to either deferred delivery of assets or final cash settlement. So these contracts are traded on organized futures exchange. I have shown you about the trading terminal and all, with a clearing association that acts as a middleman between the contracting parties. And again, sir already has told about that the contract seller is called in, you can say it in short, and the buyer is the long. We have already seen what is the short position. We have already seen a long position, and when we will be going for short position and long positions and all. So, short position will be going when we have a bearish trend, and we will go for long positions when we have a bullish trend. Then both the parties pay a margin to the clearing association. So that is, the margin is an important concept when it comes to derivative. That is what we do not take. That is what we have. Beginning of the presentation, we have said about Mr. Warren Buffett. He is not a person who is interested in speculations and all. So in the difference between investments and speculations, that in investments we take delivery of the shares, but when it comes to speculations, we do not take delivery. We just speculate on the variations of the price and we take out the profits from them. So since we do not take delivery of the products, we don't have to pay the full price of it. We will be paying a percentage of the contract value, and that is called simply that is margin. And the margins are paid on generally a mark to market basis that I will explain in the next slide. So each futures contract has an associated month that represents the month of contract. That is, now we have I've shown you a trading journal that each has an associated month, like August, September, October, and there is and that each contract has a specific delivery date as well. And these contracts are identified with the respective months, like Reliance. I have shown you about the Manappuram one. Similarly, Reliance also has like Reliance FUT July. Means July is already expired, so therefore the other months it is there. Every futures contract represents a specific quantity. Again, a very peculiar difference between equity and derivatives is that I've shown you in Manappuram we have a lot of 6,000, whereas Reliance is considered they have a lot of 250 shares. So a lot difference between each company. So we cannot put buy orders or sell orders on customized quantities like we do in equity, like we can put 10, 12, 13, or we can put it for any quantity when it comes to a few equity, but in derivatives it is not at all possible. So the margin mechanism, again, a thing we have already studied this while coming in the clearing and settlement session. We have already seen this, that we do not take delivery, we need to pay a percentage of that as a margin, because to avoid counterparty risks. So we have three types of margin. That the first one is the initial margin. So it is paid at the start of a new transaction, and NSE they maintain a percentage as initial margin for initial transactions, and the exchange can change the required margin anytime. So it keeps they have the privilege to change it if price volatility increases, or if the price of the underlying commodity rises substantially. The initial margin will be increased. That is that if the prices variations are very huge, means they keeps on changing, in that cases the initial margin will be increased by the stock exchange. Then we have maintenance margin. Maintenance margin is the margin which we should maintain, or a minimum margin, like it is similar to like the minimum balance we have seen in, says we have to maintain at the savings bank account, right? It is very similar to that. We have to maintain that much margin in the account. Coming to variable margin, it is like I have already said, there is a marking to market concept when it comes to futures. That is that these are daily settlements, so it is calculated on a daily basis. So whenever it goes below the maintenance margin, the seller, the person, the participant has to put on the money to fulfill the maintenance margin. So this is what variable margin is. This is to be deposited most often in cash only. The day's closing price is generally used as a basis for purpose of marking to market. So this just it's like, to better understanding, I have given it is a conversation happening between two persons. This is what sir has told about the when to buy, when to go for long. So it is a, from this we can understand it is a contradiction between two persons who is having a bullish sentiment and another one is having a bearish sentiment. In this case, Mr. A, he agrees to buy 500 shares at 560 each after 3 months. So he is having a bullish sentiment, and these things that the prices is going to fall, going to increase. Sorry, it is going to increase. And Mr. B, who is having a bearish sentiment, he is the person who agrees to sell the shares at 560 after 3 months. So why he is selling is that he thinks that the price is going to fall in the future. So they came to a conclusion that they will make a contract and they will sign it, and they will square up the price difference in cash. So they are not going for any physical settlement and all. So they are going to square up it in cash. So now after 3 months, the XYZ Limited shares got at 560 now. After 3 months, after 3 months the price will rise, and as Mr. B, he said, no way, after 3 months the price will soar. This is because they have different sentiments affected to them. And what will happen after 3 months? There are actually three scenarios, but two scenarios are the important one. The first scenario is that the price turns out to be 550, that is below 560. And in this case, since A speculated that he thought of buying it at, he came to a contract to buy it at 560, he has to buy it at 560 and he has to sell it in the market for 550. So the difference there is 10 rupees per share is a loss for him. And since it is 500 shares, Mr. A and Mr. B gains 5,000. In scenario 2 is that if the prices goes up to 570, in that case, Mr. A will get shares at 560 from Mr. B, and he will sell it in the open market, and the shares, so he will get 10 rupees profit per share. So Mr. A gains 5,000 and Mr. B loses 5,000. So this is called cash settlement. That is that they are not giving the shares or anything. They are not transferring the shares or anything. They are just transferring the profit. So here you can see the difference between forwards and futures. That forwards are private contracts between two parties. They are bilateral contracts between two parties, and futures contracts, we have an organized exchange. Forward contracts are not standardized; they are customized or tailor-made ones, whereas futures are standardized one. And forwards, they can fix upon the delivery date. But when it comes to futures in Indian stock market, we have maximum of 3 months. That is the maximum which they are in. And they sell at the end of the maturity, no cash exchange prior to delivery date. But when it comes to futures contract, that is where I have explained about the margin and all. So these margins are daily settled, and the profits or loss are paid in cash. So the thing is that when it comes to forwards, most of the 90% of the forward contracts settled by actual delivery, that happens in physical delivery. But in futures, most of them are actually cash delivery. But there are some SEBI regulations come into this regard as well, because after 2000, I think 2018, they told that the physical settlement has come as mandatory. Because the thing is that if there is a cash settlement, the speculation increases and the volatility in the stock market increases. So that is why SEBI has come with a regulation that they have made physical settlement mandatory in terms of derivatives, and delivery of final cash settlement usually takes place in forwards. And here contract normally closed or prior to the delivery, it is either sold or settled. So I'll give you some practical terminologies. I want implications before after. This was the first part. I thought of giving it in a theoretical way. Second part, I thought I'll show you how this terms. But since I've showed you some, it's okay. So basic terminologies. One is a lot size. We have already seen. You cannot buy or sell at customized prices. You have a lot. You have to do with that. We have a spot price. Spot price is the value of the underlying asset. So in this case, as well as futures is concerned, future stocks is concerned, it will be the value of the equity of that. For example, the Manappuram's equity at that date. We have future price. The future price is the value of the futures that also I've shown you in the trading terminal. We have an expiry date. As far as India is concerned, regarding stocks, we only have the last Thursday of every month will be the expiry date. Then we have contract value. Contract value is calculated future value into the lot size, whatever it is. So margin depends on we have already seen about the initial margin and all. So how much we have to pay margin, that depends on the percentage of contract value, and we do have a system to calculate that too. I can show you that as well. So if you to calculate the margin, it's very easy. Just go to Google and just type, for example, you can see if it's Zerodha, app stocks, anything, just go Zerodha margin calculator. Here you can see it is NFO. You can select the products, whether it is futures and options. In this case, it is futures. You can select which company you're going to. If it is Manappuram, let's go with Manappuram. It's easy one. See here, you get the lot size is 6,000. It automatically comes up. For example, if you type Reliance, it is 250 or some other. You can check Tata Chemicals is there. They have a lot size of 1,000. It varies from it. If you're going to buy it, you can check how much you have to pay. Here it comes the amount which you have to pay as a margin. Here it is 1,81,000. 564, that is the amount which you have to pay for 1,000 futures, one lot, that is one lot of uh, futures of Tata Chemicals. So it varies depending on the company and all. So this is how we calculate the margin. So again, different future contracts available, that is the near month, mid month, far month. This also we have seen it, that we have 3 contracts, right? So in this case, August, September, October. At this particular type, we have August, September, October. So the contract for in August we call it as near month, and the contract for September we call it as mid month, and the contract for October we call it as far month. So these are the terminologies which you should be aware. Well, and the rollover concept is that if by the end of this term, that is by the end of the near month contract, you find that this will not be, then in that case you can just sell it and purchase it again. That is called rollover concept of futures. And what happens when you initiate a trade? That is, when you put a buy order, what are the things that happen? That is what I'm going to explain here. That is a margin. The first concept is margin validation. The first thing that the broker system checks is that whether you have that much margin in your account. Means if Tata Chemicals, it was 1 lakh.
Yes, Snehith, what happened?
And in future, yes sir, okay. So we have a counterparty search happening in the futures, that if you are a buyer, we exchange searches for the seller. And then the third is that the sign off, means after the counterpart, after we find a buyer and a seller, a digital contract is signed using the digital signature. And then since the margin validation was the first step, in the last step they will keep a margin block. That is, after the contract is signed, that you cannot use that margin for any other trades. That particular margin would be
Snehith, I have a
blocked.
question. I have a question. If a person
Yes sir.
who uh, buy future, I mean long position of Reliance Industries,
Yes.
and the other party means the person who a person who will be there to sell that Reliance Industries future, then only the person can be able to buy it, right? So two
Yes
parties,
sir. Yes sir.
a person who buy Reliance future, and a party who sells Reliance future.
Yes sir.
So suppose that contract maybe a 4 month contract, 3 months contract, 3 months, right?
Yes sir. Yeah, 3 months. 4 months is 3 months.
Okay. So how can the settlement take place? Means the party can, if the party has the option to settle before the 3 months, or it can be settled only after 3 months.
So as far as I am not much clear on that, but as far as I know, it can only be settled on 3 months after the expiry, I guess. So
Okay. Before that, the person who buys the future has no option to settle it, right? So
yes, sir. Yeah,
what is the issue of future? I'm talking about the problems of future, because if a person who buy future or sell future, its losses is unlimited.
yeah,
Unlimited.
yes, sir. Its
It's
losses are unlimited. Yeah,
unlimited, and profit are also unlimited.
yeah. That is that is why the reason I think that Warren Buffett has defined it, like, because it has unlimited profits as well as unlimited loss. But
Loss.
and it is also a point of difference between options, because in
Yeah.
options we
So
have limited
so
loss.
that the limitation of this future has lead for the emergence of options. Option, we can limit the
Yes,
loss.
sir.
Limit the loss.
Yeah, because the loss will be only maximum loss which is going to incur in the options case is the
Limit
option premium.
up to the premium, option premium. Okay.
That is
So
one of the primary
the
difference.
option definitely one party will lose and other party will gain. The only one party will be
Yes,
the gainer and other party will be definitely a loser.
yes, sir, exactly.
Yeah, that is a problem of future. So that there is a risk associated with the future. It's unlimited losses and unlimited profit.
And
Okay.
that is also one of the primary reason why the margin for futures is higher when
Yeah,
compared to
exactly,
options.
exactly. Margin for future is higher, and if you buy future and after that your position is weak, then the broker again call it you for making maintenance margin.
Yes, sir,
So
exactly. That is that
yeah,
that marking to mark.
marking to market. Yes, yes, exactly.
Yes,
Okay, continue.
yes, sir. So yeah, here again you will be having a question. If I buy a futures, what are the options that I have before it? Whether I have to hold it till expiry or can I do something else? Again, I think I will answer the question what sir has asked right now. That in the beginning itself, I have shown you the how the things works, right? For example, Manapuram has their own futures. So for example, August futures is here. So again, I have told that the future is also similar to stocks, that it has minute to minute variations and all. So even if you buy a future, if you can buy a seller who is interested in buying the future, you can sell it. Like wise you can, for example, you can buy at 169. You can buy, even you can buy a future at 169 and you can sell it at 185 or 200. Like you trade in equity, the same way you can trade in futures as well. So that is one of the way you can use it as a trading instrument. That is, you buy it and if you get a better price for the future, like stock, you sell it. The other option is the traditional option, which have we either buy or sell it and hold it till like expiry, and we wait for what will happen in the future, and depending upon the conditions we settle it. So these are the ways which we can, what you can do with futures. Either you buy or sell it and hold till expiry, or you can use it as a trading instrument. Again, a question which arises in your mind is whether for every company is futures and options available. Yeah, but it is not available. It is not like that. Only those companies which are sound, means there is a criteria which the SEBI has put up, and only those companies can issue futures and options. All the companies cannot issue futures. Illiquid stocks or low volume stocks, they cannot issue futures and options. Only the prominent ones. You can just search if you want on the trading terminal on what are the companies. So it will be all the prominent ones. Means they will be having a set criteria for that. Only they can trade. And again, what makes futures exciting while comparing to the equity? The first one is the risk sharing. Well, usually I find those people who trade in futures is that they trade in equity, and when they have a loss in equity, they try to hedge that loss using the futures. The benefit of futures is that in as far as equity is concerned, we will be only gaining if the price rises. As far as equity is concerned, we need a higher price, and when the price rises only we will gain. But when futures is concerned, it is not like that. As far as futures, sir has already explained, it is unlimited losses, unlimited profits. So there is no good time or bad time for futures. Even if you are having a bearish time also, you can make profits out of futures. So that is the benefit which you have when it comes to futures, that you can share the risk in equity, and lesser margin money to require to buy and sell. That lesser margin money in the, not compared to options, but
Yeah,
compared to
the
options, of
thing
course, it
is,
has.
if you wanted to buy an MRF share, you have to spend 95,000 rupees for one share.
Exactly, sir.
Yeah, but we can buy future very limited with I think 10,000 rupees we can buy MRF future if it is available. I don't know MRF future is available or not, but we can buy future with a very limited amount of money as compared to the original price when we buy it from the cash market. So that is
Yes, sir, I will.
that is a major advantage of future.
Yes, sir. Exactly. So I'll show it in the next slide. I've shown you about the Reliance one. I will show that. So that this lesser margin money is, it is not, do not confuse. It is not compared to options. It is comparing with equity. And another one, attractiveness you have in futures is that you have a lucrative option of trading in index like Nifty. In equity you cannot trade in Nifty, but when it comes to futures you have an option of trading index. Like I can show that too. For example, here you can just type Nifty FUT. Yes, like the equity for Manappuram we had the same way, similar for Nifty also we have Nifty August FUT, Nifty September FUT, and Nifty October. It is a very safe bet again, while because it is a very diversified one, right? Combination of different companies. Again, it is a safe bet when compared to equity and all. So again, sir now has told about the lucrativeness about in the attract why people are attracted to futures than equity. For example, I can show it with some max here. When it comes to Reliance equity, suppose it is not, I think it's somewhere around, when I made the slides, it was 2086. Reliance equity shares were traded at 2086. And if you are going to buy, as I have shown you that in Reliance, one lot is 250. So if you're going to buy 250 Reliance equity, you need 5,21,500. But on the other hand, if you're going for Reliance futures, if you are going to buy one lot, you just need 1 lakh 15,491, and you might be having how I found out that is again I had typed it in the margin calculator. I can show you it in real time if you want. Just go NFO futures again, Reliance for August. Let's go for August. 250 is the quantity I'm going to buy. See, now it is lesser than that. Now it is 1,13,920. You can get 250 futures. So, but if you go for equity, you need 5,21,000. For futures, you just need 1,15,491. So that is the, again, we need less money. With less money, we can make more profits if we do it fruitfully. Otherwise, we are going to make unlimited losses as well. Because we should tell about both the conditions, right? And the same thing is happening here. If intraday if I'm going to do intraday and if I have a capital of 12,000 and if my broker is giving me leverage of 10x, I assume that you all know what is leveraged finance and all. So in that case, I have 1,20,000. So with 1,20,000, if I go for equity, I can get somewhere around only 57 equity shares. But when I go for a futures, I can buy one lot, that is 250. But now the thing is that if I have shown you that the prices of equity as well as futures is proportionate, that if two 2 rupees of futures equity increase, 2 rupees of futures will also increase. And in that case, around 250 means that is by 57 is like 4 times more you get. So if 2 rupees increase in equity, you will just get 2 rupees. But when it comes to equity, you will get 2 into 4, 8 rupees you are getting gain there. That is the attractive interest. On the other hand, it doesn't happen always like that. If it goes 2 rupees down, here you will be having -8. That also we should tell while explaining the attractiveness. That is the risk involved in futures trading. And the index futures, I have already shown you the Nifty futures and all. How it is the attractiveness of Nifty futures like this. We have seen it is very diversified. There are 50 companies. For example, if it is Nifty, it is 50 companies, and that too the major higher market capitalized companies. And it is very hard to manipulate because it is not possible to manipulate all those companies in it. So even if one stock may go down, but others will stay up. So and it is highly liquid because as compared to equity and all, Nifty it is an index, right? So it's common sense that it is a very liquid stock. We need less compared to equity. We need lesser margins for index futures. It is broader economic call, and Nifty again it is less volatile because yes, in the last unprecedented times due to COVID, it has gone like to 7,000 and all, but still it doesn't go to 7,000 or 8,000 in one go. It happens if something unusual happens, but in all other conditions, it will, for example, now for the past few days, it is somewhere around 15,700 or something. So it keeps on like that. So these are the advantages of Nifty, or I mean index futures, or Nifty futures, or anything else. So this is what I wanted to give you an explanation on futures. And if you have any questions, you can ask me. If I know, I can explain.
Okay. Now you are understanding the difference between forward and futures, and what are the distinctions between the cash market and derivative market. And derivative market, you know, the value of derivatives depends on the value of the underlying assets. Here, the underlying assets, if we do with the equity stock, the underlying asset will be stock, and if you do with the Nifty, the underlying asset will be Nifty. So, Snehith discussed both index futures as well as stock futures. So, hope you understand, and you can watch the video again and again, and make it things are to be understand in a clear manner. Then only the continuation portions will be discussed in the coming semesters about the derivatives. So it is very
Yes, sir.
important.
We in the next sem actually we do have a subject itself for derivatives.
Yeah, exactly. So, and there are questions. Problems part is there with the settlement. I mean, margin, market margin, maintenance margin, etc. The problems may be asked from this portion. So, hope you are understand.